Donald Trump passed a law in 2019 that directly led to the collapse of Silicon Valley Bank, and I'm going to explain exactly how. See, banks don't fail often, or at least they're not supposed to. After all, the entire American economy is built on that one belief, and more importantly than that, trust. Trust that when you deposit money into your account, you'll be able to access it at any time. Our massive trillion-dollar debt is based on the fact that other countries trust that we're going to be able to pay our bills whenever they come due.
Trust me.
But what happens when that trust is broken? Well, we saw that play out in 2008. The failure of Washington Mutual, which was the largest bank failure ever, plunged us into a deep recession that lasted for years. We said, nope, never again. Won't catch us slipping. So to ensure this never happened again, we passed a law called the Dodd-Frank Act. Republicans
Hate it.
The act is a pretty big deal. It's over 800 pages long, and it covers everything from credit rating agencies to derivatives trading. But here are a few key things it does. First, it creates a Consumer Financial Protection Bureau, which is tasked with making sure that banks and other financial institutions are playing by the rules and not screwing over consumers. Second, it requires banks to hold more capital on their balance sheets, which means they're less likely to go belly up if things go south. Third, it puts limits on the amount of risk that banks can take on, which should make them less likely to engage in risky behavior that could lead to another financial crisis. And fourth, it makes banks subject themselves to stress tests. Now you might be thinking to yourself, what the hell is a bank stress test? And honestly, you're not alone. It's not the sexiest topic in the world, but it's super important nonetheless. A bank stress test is a hypothetical scenario designed to test the resilience of a bank's balance sheet. The idea is to stimulate a severe economic shock, like a recession or financial crisis, or the Fed raising interest rates like a possessed person, and see how the bank's finances hold up. It's kind of like a fire drill for banks. Now, if you're thinking that this sounds like a good idea, you're right. It is a good idea. In fact, after the 2008 financial crisis, regulators around the world started implementing these stress tests as a way to prevent another meltdown. The tests are meant to make sure that banks have enough capital to withstand a worst-case scenario and avoid a collapse that could take down the entire financial system. But here's the thing. These stress tests are for banks who have over $50 billion in assets, or at least that's how it was until 2015. See, in 2015, Silicon Valley Bank President Greg Becker pushed legislators to exempt more banks, including his own, from the regulations passed in the wake of the 2008 financial crisis. Becker argued that his bank would soon reach $50 billion in assets, which would trigger enhanced prudential standards and more stringent regulations, stress tests, and capital requirements. And old Becker couldn't have this. Why should he have to spend some of the bank's money to make sure they were in a good position? We should just trust him, you know? Becker insisted that $250 billion was a more appropriate threshold and warned that without such changes, Silicon Valley Bank will need to divert significant resources from providing financing to job-creating companies in the innovation economy in order to comply with these enhanced prudential standards and other requirements.
That smells like bullshit.
Which really means we don't want to play by the rules. We just want to give loans to the cool tech companies in Silicon Valley. And we're in Silicon Valley. We're smart. You don't have to worry about us. We're not like JP Morgan or Citibank. Federal disclosure records also show that the bank was lobbying lawmakers hard on financial regulatory reform. The lobbying worked because in 2018, President Donald Trump signed into law the Economic Growth, Regulatory Relief, and Consumer Protection Act. This increased the regulatory threshold for stronger stress tests from $50 billion in assets to $250 billion in assets. Silicon Valley Bank was in the clear. When the Federal Reserve proposed regulations implementing this law, financial watchdogs warned that its regulations on Category 4 institutions, as Silicon Valley Bank was later classified due to its size, were far too weak.
Oh, no.
The final rule guaranteed that Category 4 institutions were not required to conduct and publicly report, which is very important, the results of a company-run stress test. In 2021, Silicon Valley Bank passed the threshold of $100 billion under management. This triggered some additional scrutiny as a Category 4 bank, but it fell short of the more frequent and detailed stress tests that regulators perform to determine whether banks above that $250 billion of assets have sufficient capital to withstand a crisis. And guess what? If that law was never signed by President Donald Trump,
could you call me Mr. Idiot?
Soon as Silicon Valley Bank went over the 50 billion threshold in 2020, the bank would have to undergo stress tests. And the stress test would likely have revealed that the bank had an enormous concentration of risk in one industry, tech.
Big mistake. Big. Huge.
And the bank used a lot of customer deposits, and I mean a lot, to purchase treasury bonds that no longer look like a good investment due to the Fed raising interest rates. There's a good chance Silicon Valley Bank would never have even purchased the bonds because it would come up in a stress test. The stress test was a way of protecting Silicon Valley Bank from itself. Getting rid of the stress test on its own was bad enough. But then the Federal Reserve had to go and be complete idiots and change from requiring banks to have fractional reserves to having no reserves. At its most basic level, fractional reserve banking is a system in which banks are only required to hold a fraction of their deposits as reserves and can lend out the rest. So, for example, if a bank has $100 in deposits and a reserve requirement of 10%, they only have to hold $10 in reserves and can lend out the remaining $90. Now you might be wondering, how can they lend out money that they don't actually have? And the answer is, they create it.
Dude, we've created a monster.
When a bank makes a loan, they're essentially creating new money out of thin air.
We'd make millions of dollars.
And as that money gets deposited into other banks and the cycle continues, more and more money is created. So while fractional reserve banking allows for the creation of money through lending, it also comes with major risk. If too many people try to withdraw their money at the same time, the bank might not have enough reserves to meet those demands and could face a bank run. And if too many loans go bad, the bank could become insolvent. That's why the Fed imposes reserve requirements on banks to ensure that they have a decent amount of liquidity to meet the demands of their customers and prevent bank runs. But guess what? In 2020, during COVID, the Federal Board of Reserve changed from fractional reserves to none.
Oh yeah, that makes sense. No, it doesn't. Not cool at all.
In early 2023, the Fed began telling banks they would have to build up reserves again, but stopped short from making it a requirement. So, Silicon Valley Bank took customer deposits, and instead of keeping even a percentage of it in their vaults, it either lent it all out or used it to invest. The investments Silicon Valley Bank made were largely in mortgage-backed securities and government bonds. These aren't the same subprime mortgage-backed securities from 2006. These were the plain vanilla ones, the safe ones. So safe that their return was only 1.5%, meaning if an investor buys a $100,000 mortgage-backed security with a 1.5% return, they can expect to earn about $1,500 in returns over the course of a year. But the Federal Reserve has been so focused on lowering inflation that they have been raising interest rates. When you raise interest rates, the returns on safe securities like vanilla mortgage-backed securities and government bonds also go up. So those same securities that a year ago only had 1.5% return jump to 5 or even 6% return. That same $100,000 would earn the investor $5,000 to $6,000 now with the new return.
Now we're talking.
So when Silicon Valley Bank's customers came asking for their money, the bank had to sell those 1.5% return securities at a $1.8 billion loss. But do you know what would have stopped all of this? Two things really. One is having the bank undergo stress tests as soon as it passed $50 billion in assets, because then you get to look under the hood and see what's really going on. And two is having the bank have at least some of the cash on hand. But without those two, you get what happened last week. 3 bank failures in 1 week. But you know what wasn't going to take a loss? The CEO, Gregory Becker. He sold Silicon Valley Bank stock on February 27th and made $3.6 million.
Oh, sell.
Since 2021, he sold $29 million worth of shares. And he wasn't the only one. Insiders at the bank sold over $150 million worth of stock in the past 2 years. First Republic, another bank on the brink of a potential collapse, had insiders who sold over 79 million in shares. And it's not over. And in my next video, I'm going to talk about the death of the FDIC and the broader US economy. It's going to change our economy forever. And if it's out already, you can check it out right here in this video.